Welcome everyone. My name is Laura Baldin. I'm the head of sales and marketing for AgInvest. Thank you very much for taking the time today to attend our first webinar. We believe on a very interesting argument, why to sell Google and buy Africa. As most of you know, we run an alternative liquid strategy on the financial market in Africa since 2015. We are very happy of the results, in particular for this year. So we think it will be important and very interesting to touch this topic today. With me to cover on the argument, we have Dr. Ayo Salami, is the CIO for the Duet Africa Funds, and Eric Renander, portfolio manager for our HIMM Africa Fund. So during the conference and at the end of it, you might have questions, and so please do your question using the chat. And I don't waste any other time, and I'll turn it over to Dr. Ayo.
Thank you very much, Laura. Good morning and good evening and good afternoon, ladies and gentlemen. And let me echo Laura's sentiments and thank you again for taking the time to participate in this seminar. Why you should sell Google and buy Africa. We're not actually going to spend a lot of time talking about Google. The idea of the title was just to represent or to convey the idea that it may be time for investors to look away from that segment of the market, big tech, and looking at investing in G7 countries, and to start looking for other opportunities, especially given the kind of dislocation that we have seen in markets this year as a result of the COVID-19, pandemic. If we start off to sort of try and give you some idea about what is COVID-19 doing in Africa and the likely impact it will have on the economy of the region. The slide on page 3 tries to give some general data which we have obtained from the WHO. Now, it is a self-evident fact that Africa has weak health infrastructure. And you can see that if you look at the slide on the right, where you look at the amount of the testing that is being done within the population. In Europe, per 1 million of the population, Europe is testing roughly around about 36,000 people. North America is testing around about 25,000 people. Whereas in Africa, the test is only around about 1,000. So Africa is testing at a rate which is less than 2% the rate at which the rest of the world is testing. And that starts to be reflected in the number of cases of COVID which is being reported in Africa. Because when you look at the number of cases per 1 million of population, only about 70 people in Africa have been reported to have COVID, whereas in Europe, the equivalent number is around 2,500. And so you can certainly, one can certainly draw the conclusion that lower testing leads to lower cases of COVID, and that there might be more cases that Africa might at the end of the day report higher levels of infection rates. But whatever the infection rates are, one number which is which is startlingly different for Africa compared to the rest of the world is the outcome. If you are unfortunate to get COVID, your recovery or non-recovery is the final outcome of this horrible disease. And here, the numbers are very startling, because in Africa, death per million of the population at the moment is only 2 people per million of the population dying from COVID. Whereas in Europe, that number is around 220. In North America, it's about 175. Even if you don't accept the African numbers for testing and the African numbers for cases, the numbers for death are very difficult to manipulate. If large numbers of people in Africa are dying or being turned away from hospitals, that will be something difficult to hide. And so the original premise which we had when this pandemic broke out, that it would cut a swathe of disaster across the African continent and the continent would not be able to cope, is not panning out. Certainly it is possible that we might see higher death numbers, but from 2, we're talking about 2 per million at this stage of the pandemic. The Africa's numbers are going to rise. They're probably not going to rise above 100. whereas the European numbers are still rising and are currently well above 200 per million of the population. What are the reasons for this? I'm sure a lot of studies will be done to look into this, because one of the anomalies you have with this disease is that in the United States and in the United Kingdom, for instance, there is a higher incidence of death among the Black, Asian, and minority ethnic population than there is among the Caucasian population. Yet in Africa, we're not seeing very many deaths. So what explains this? A number of explanations have been offered. One about humidity and the hot temperature. I don't subscribe to that, because if that was the case, then we should see similar numbers in Asia and Latin America. Another plausible one, which I'm sure science will explore a lot, is the role of malaria. You know, malaria is still very, very prevalent in Africa. And if you survive malaria and you go past the age of 5, you will already develop some antibodies. And it's those antibodies that are mimicked by that drug, hydroxychloroquine, the drug that Donald Trump is now taking. And it is possible that Africa has a higher level of these malaria antibodies, that Africans have this, and this is helping them in fighting this disease. But more than anything, I mean, while science, this is something for science to look at, I think a simpler explanation for this simply comes from demographics. And if we look at the slide on page 4, the demographics issue, I think, is probably a very strong way of understanding why this disease is not cutting such a terrible swathe through the African continent. Because unfortunately, the death rate or the fatality rate for COVID is much higher among members of the population who are above the age of 50. It's almost about 75% of those who have died are over the age of 50. And here, the demographic favor Africa, because today, only about 15% of Africa's population is actually over the age of 16. I mean, is over the age of 60. More than 70% of Africa's population is under the age of 25. The median age in Africa is 19, and you can compare that with the median age in North America and Europe, which is closer to 40. And now, why it affects young people less than older people, that's something, again, that science will probably have to look at in the future. But that demographic advantage does imply, or does begin to suggest, that this thing is not a monster that is going to devastate the African continent, but that it's more likely that its impact on the population and on the health of the continent is not going to actually be abnormal. So that then leads us to look at what are the other impacts that COVID is likely to have on the African continent. And I think on the economy, if it's not devastating the health system and it's not causing higher death rates within the population, then the main remaining transmission route for COVID to affect the African economy is via the external current account. And by that, I mean a deterioration in Africa's terms of trade. What we are likely to see, and there is increasing evidence of this, is that the global economy is likely to go into a recession, or at least a period of sustained slower growth. Sustained slower growth would mean that commodity prices are likely to be adversely affected. And if commodity prices are adversely affected, then this would mean a worsening of the terms of trade for the African continent. That worsening of the terms of trade is the main risk that COVID represents to the African continent today. But even there, it is not all bad news. Because when we look and when we try to break down the components of growth in Africa since 2000, only 22% of growth in Africa has come from external accounts or from international trade. And this is understandable because Africa constitutes less than 5% of the global population and only about 2% of global trade flows. So it's not the external trade that drives Africa. What it does is that it provides the revenue for the public sector, pay for public sector infusion of liquidity into their own domestic economies. And in this case, with 60% of growth in Africa being explained by domestic consumption, the primary objective of most African central banks and the policy response that we are seeing on the continent to this COVID crisis has been how to protect that domestic consumption. And the playbook The main impact is going to come from currency weakness rather than economic slowdown. Because what African countries are in a position to do is to use their exchange rate as a shock absorber to absorb this exogenous shock so that their domestic economies are protected. If the price of copper drops by 50% and you allow your exchange rate to drop by 50%, then the local currency value of your export earnings will stay the same, and that will protect your domestic economy. And that is more likely to be the way we're going to see the impact of COVID affecting African economies, is that we're going to see it in a deterioration in exchange rates rather than a devastation of domestic consumption. The reason why domestic consumption is not going to be adversely affected is also because you don't have significant amount of free cash transfers in Africa. So what we are likely to see in Europe and in the United States, with the rising unemployment rate, you are likely to see a significant removal of productive capacity out of these economies, which might take some time to be put back. That would then lead to a recession, which would have an adverse impact on commodity prices. Whereas that unemployment rate is not going to be higher, it's not going to shoot up in Africa because over 70% of the economy actually survives in the informal sector. And in that informal sector, you don't have an employer who's going to make you redundant. You have to take care of yourself. So you can't afford to be unemployed. You have to be economically productive. And that means your domestic consumption is going to stay, so long as there is sufficient liquidity coming in from the public sector. So what we are expecting in Africa, our expectation is that GDP growth in Africa will probably slow down from about 4.5% to somewhere between 1% and 2% this year. What it's not going to do is it's not going to turn negative. And by not turning negative, that means these economies do not go into recession. And that's a critical point which underscores the investment case for the continent. So now look at how this investment case translates into risk assets. If we look at the slide on page 5, this is a difficult one. It's both an interesting and a paradoxical chart to explain. Because what this chart shows is the performance of risk assets or equities in different parts of the world since December 2007, just before the global financial crisis. And when you look at what has happened to the G7 economies or G7 countries, these 7 countries have practically doubled from where they were before Lehman's. They've recovered all of their post-Lehman losses, and they have gone up by almost 100%. Africa, however, is still down about 50% relative to where we were at the time of the Lehman crisis. So undoubtedly, the investment case you would have, this chart, what this chart tells you is that post 2008, it's no contest. You should have been invested in the G7 countries, and the G7 returns have been driven. Primarily, as you will see in subsequent slides, it has been driven by QE and liquidity expansion. And that liquidity expansion has driven the relentless rise of passive investing, primarily via ETFs and share buybacks, which explains why the equity markets in the G7 countries have gone up by almost 100% post-Lehman, whereas Africa has not benefited from this same type of liquidity flows, and therefore we are still down around about 50%. Does that mean that investing in Africa is a mug's game or a loser's game? No, because what the slide on page 6 shows you is that actually the longer-term returns vindicate the position of investing in Africa. Because if what you looked at was returns over the last 20 years, including, and I repeat this and I place emphasis on it, that even including the excessive amount of liquidity that has been pumped from QE, which has driven risk assets in the G7 countries, the annualized return from G7 investing in the developed world since the beginning of this century has only been around about 2% a year. Whereas the returns from investing in Africa have been closer to around about 5.7. So even though we have not benefited from the liquidity, the relentless drive in liquidity, in liquidity inflated assets, our fundamentals has actually driven and explained a longer term positive return in Africa. And unfortunately, in terms of investing, people remember what happened yesterday. They don't remember what happened 2-3 weeks ago. We all now forget that if you had been investing in the G7 countries from 1995 until 2007, your returns were negative. A period of almost 15 years when equities in the G7 countries did not give people positive returns. And that was when pension deficits started to grow, started to blow out. But we've all forgotten this because post-2008, we've had the impact of QE, making all of us feel very, very good about investing in Google and Apple and Microsoft. And we forgot that there was a long period of time when investing in this asset class, which now looks like which now looks like the flavor of the month or the flavor of the period, did not do anything. And that almost 15-year period is why you have this very, very significant difference in the long-term returns. And we think those long-term returns are going to again, even though we've had a significant period of outperformance from the G7 over the last 10 years, it has not yet been enough to catch up for the losses that people experienced during the previous decade prior to 2008. And you can see and understand why this is the case. It is because G7 economies are not actually growing when you look at the slide on page 7. Because what the slide on page 7 does, and you look at I'm going to focus on the slide on the right-hand side, which shows the cumulative growth in nominal and real GDP post-2008. Despite the amount of money and the QE and the expansion and accommodative monetary policy that we have had in the developed world, the nominal GDP of the developed world has only grown by about 50% in the last 10 years. Their real GDP has grown by roughly something of the order of around about 12%. It's actually been just under 1% a year. The US has done slightly better, Europe has pulled it down, Japan has not done anything. But the average has been around about 1% a year for that period. When you look at Africa and the emerging markets, despite the fact that we've not benefited from QE, nominal GDP growth has almost doubled in the last 10 years, and real GDP growth has grown by almost a factor of 55%. But that real growth in the economy is not being reflected in the performance of risk assets. And that's what the slide on page 8 sort of emphasizes. And so what you see in the slide on page 8 is the impact of the anomalous behavior of corporate earnings relative to the performance of share prices. So on the slide on page 8, if you look the slide on the right-hand side, it shows since 2013, on average, corporate earnings have grown in Africa by almost 90%. And yet, corporate share prices have dropped by almost 30%. By almost 27%. Earnings have grown, share prices have fallen. And that has translated into what you see on the right-hand side, where you've not seen multiple expansion. What we've actually seen is multiple contraction. The markets which used to trade on PEs of around about 14, now trade on PEs of under 10. And we now have stocks in Africa which are generating, dividend yields are now higher than local domestic interest rates. Is this going to turn? Or is there any reason for this to change? Yes, we believe the circumstances and the opportunity, and the circumstances for that change are beginning to come into play. I highlighted earlier that we had a long period of almost a decade when corporate earnings were not growing in the G7 markets, and this was reflected in the poor performance of equities. We're about to go into a period again where earnings growth is going to be difficult to come by. Quantitative earnings, I mean, no question about it that the central banks and the fiscal authorities in the developed world have put up a Herculean and heroic effort to try to protect the domestic economy from the impact of COVID. But can you believe, when you look at the last US jobs report, in one quarter, the US has lost the same amount of jobs that it took 10 years to create. They've lost in one quarter the same amount of jobs that it took them 10 years to create. They're not going to get those jobs back in one quarter. While we don't know what the shape of the recovery is going to be, what is clear is that the Western economies are beginning gradually to lose productive capacity. Productive capacity is being taken out of these economies by COVID. And this is a structural thing that is going to take some time to work its way through. And we're now likely to go through a period of earnings recession. And that earnings recession will mean that when people start looking at the expectations and the valuation of the markets, the valuation of markets in the developed world, there will, you're now talking about markets where your PEs are going to, if they stay flat, then PEs are going to start going into the range of 28, 30. The weight of expectation of earnings expectations will not be met. And at that point, the old-fashioned things that we use, that we worry about in our markets, corporate earnings growth, dividend yield, return on equity, will begin to become important again. In the search for performance, people will start to look again at where are companies still able to grow earnings? Where are they still able to make profit? Where did COVID not devastate the economy and take out a significant amount of the productive capacity of those economies? I think you will find when that search begins, Africa will be very, very well placed to be able to produce and to be able to give investors returns. So if you look on the slide on page 9, essentially what we're saying is there was a period from 2002 to 2007 when African markets generated in public equities, you generated the type of returns that you could get in private equity investing. From 2002 to 2007, the cumulative return in African equity markets was around 350%, from 02 to 07. And we saw significant multiple expansion because earnings did not keep up. Now the markets have derated, and you now have the opportunity again to buy African equities at the valuation levels last seen in 2000, despite a decade of significant economic growth and economic expansion. It's a rare thing. You missed it the first time, you get a chance, a second chance to be able to buy back what you did not see the first time. And in economics, unfortunately, we always change can happen in front of our eyes and we don't see it. And the fact that COVID, the impact of COVID is, in our view, going to be very radically different in Africa than it is going to be in the developed world. It will lead to slower growth for a period of time in Africa. It's not going to lead to a recession. That means African companies are still going to be able to grow earnings. And our expectation is that for 2020, we will see single-digit earnings growth this year. Whereas I would submit that in the developed world, we are more likely to see negative earnings growth. Going forward, that ability to generate earnings, to pay dividends, is going to be a differentiating factor for African companies, and it will then begin again to bring the continent back into favor. And with that, I will hand over to my colleague, Eric, to tell you more about some of the opportunities that we see on the continent.
Thanks, Ayo. Hi, it's Eric. I'm the portfolio manager for the HI-EMIM Africa Fund. I'm taking over on slide 10, and I just want to make the point that we generalize, we say Africa, but we just got to remember it's a very big continent with 53 diverse countries. And I just try to make the point here, you've got Cairo up in the northeast, Lagos out in the west, city like Cape Town down in the very bottom of the continent, and then Nairobi in Kenya out in the plains of East Africa. And they're all very different economies with different drivers, different exports, imports, and industries. So just to generalize, but know that it's a very differentiated continent. Going on to slide 11, another generalization I hear is Africa is just a commodity play, or does it do well if commodities go up or go down? And this slide is just to show the main oil exporters in Africa. And as you see, Nigeria on the west coast, Nigeria, Angola are big oil exporters, along with Nigeria and Libya. Then you've got major parts of Africa that don't export oil. Morocco, Egypt, all down East Africa, Ethiopia, Tanzania, Kenya, Rwanda, Mozambique, South Africa are all oil importers, and they actually benefit from the oil price going down. So it's differentiated. Sometimes some countries benefit, some countries are hurt by low oil prices. Then going on to slide 12, I made some great points about the valuations in Africa on a market level. I have this slide I like to present, which is just companies you can buy for under 5 times earnings in Africa. And you've got the first two are Access Bank and Guarantee Trust are some of the biggest banks in Nigeria at 2 to 3 times earnings. Rascom Construction is one of the leading construction companies in Egypt, and also pretty big in the Middle East as well, in Dubai, under 4 times earnings. Kenya Commercial Bank is the biggest bank in East Africa at 4 times earnings. Africa Rainbow Minerals is a quite large diversified mining company in South Africa. Nedbank is one of the biggest banks in South Africa. Telecom Egypt is the leading fixed line, kind of like broadband provider in Egypt, but also owns 49% of Vodafone Egypt. So it's not just fixed line, it's mobile as well. So that company is at 5 times earnings. Epico, which is the Egypt International Pharma Company, is a drug distribution company, 5 times earnings. And Old Mutual Insurance is the biggest insurance company in Africa. Very, very well established South African insurance company at 5 times earnings. So I think that's quite interesting. Another thing I sometimes hear is, there just aren't any tech stocks in Africa. It must be just all cement companies and beer companies. But actually, there's been a growing public listing of technology companies on the exchanges in Africa, and also on the international exchanges like the New York Stock Exchange and LSE. I just want to share a couple examples. Fowry is an Egyptian payments company which IPO'd last year. Discovery is a South African insurance company with a very interesting insurance product where the premiums change based on your activity. If you have an insurance product in the US or Europe that's got the word vitality, it's called that branded as a vitality insurance product. That was invented and managed by Discovery in South Africa. Jumia is an online shopping company with operations in several African countries, listed on the New York Stock Exchange. And then you have several mobile phone payments companies. So you have Safaricom, which is well known in Kenya with their M-Pesa payments, and you have MTN, which is the biggest mobile operator in Africa, which is also getting into mobile money. And you got Naspers, biggest technology company in Africa, which owns about 31% of Tencent in Hong Kong, listed in Hong Kong. Network is a credit card payments business, and MultiChoice is the leading media business in Africa. So you see there's a mix of media, technology, payments, logistics on the African exchanges. So I thought I'd talk about a few themes that we're looking at with the fund that I thought would be interesting for you. And one is the growth of the mobile economy in Africa. And this is something I think is unique about Africa relative to mobile companies in, say, the US or Europe. And this is on slide 14. Now, what you see is the mobile penetration in Africa is still has room to grow, along with the inherent population growth. And the point is, we're probably going to add about 150 million subscribers over the next 5 years across the entire continent. And that's just a number you don't get with like AT&T or Verizon or Telecom Italia. So there's just, with these mobile phone companies in Africa, you just have a lot of you're going to just continue to have good subscriber growth. Then if you go to slide 15, I already talked about the very young population in Africa, But for the mobile economy, which is very interesting, is that you only have 23% smartphone penetration, and with that also very low mobile data penetration. So, you know, you have this growing customer base, but you also have the growth from the adoption of, you know, people upgrading from a 3G phone up to a smarter phone. And so if you go to slide 16, this is a slide put together by GSMA Intelligence, which is it's a publication by the mobile phone industry. And you know, what they're predicting is that the average data use per customer per month can grow from 1.7 gigabytes right now up to over 7 gigs a month over the next 4 years. And that's just basically taking a guy on a 3G phone and putting him on a smartphone. So, you know, you've got these two big drivers. You've got growth in subscribers, and you've got those subscribers upgrading to better, with phones with better functionality, driving a lot more data usage. And then the third piece, which is on page 17, which is also unique to Africa, is many of these phone companies have their own payments business as well. Safaricom in Kenya is very well known. They have the leading payments business in that country called M-Pesa. And in East Africa, these mobile payments businesses have been kind of leading the rest of Africa. But as you can see from the chart, you know, you've gone from 300 million customers up to almost 400 million mobile payment subscribers in Africa. As I said, led by East Africa. But then if you go to slide 18, we think that West Africa is going to catch up. And there's a couple nice, kind of interesting developments. MTN, which is the largest mobile operator in Africa with about 250 million subscribers, they're excited about the potential growth of data, but they said, you know what, a lot of our customers can't afford a smartphone. They don't have a few $100s for a smartphone. So what do? How do we get them to use more data? So they developed what they call Smeacher phone, which is basically a smartphone with just a lot less functionality. And if you look at the picture, you can see it's a smartphone with a Facebook app, a YouTube app, a WhatsApp, a Google Maps, and also could be used for payments as well. But it only costs $20. The other picture I just thought was interesting is this kiosk. You see these around Africa, and especially where there's mobile payments. These are on the street, and you can go up and use it to buy airtime, or actually cash in for your mobile payments account, or take cash out. So it's like a little mini bank branch right on the street. So that was, Joey, going on to slide 19. Another theme is West African gold miners, and we do own 2 West African gold miners in the portfolio, Endeavor Mining and B2 Gold. And it's may not be something that you probably maybe think of gold mining in Africa, you think of South Africa, but West Africa has really come up a lot. And this is, this is Cote d'Ivoire, Ghana, Mali, and Burkina Faso over in that western part of Africa. Going to slide 20, this is just discoveries by region over the last 10 years. And as you see, 79 million ounces have been discovered in West Africa. And it's the biggest area of discovery in the world. If you go to slide 21, equity raises, second biggest region for raising money, $6.35 billion went into West African gold mining. Bigger than Australia, bigger than the US. And also what's with that is the governments in West Africa have been very supportive of mining, very protective of mining rights and legislation, and acted very well. And so the industry has gotten very comfortable with mining in West Africa. And so you see all that money coming into the region. And then just slide 22, just interesting to see that West Africa has become the fourth largest gold producing area in the world. It's not exactly a correct comparison because this chart is mostly individual countries, and we're grouping West Africa all together, but it's still notable that there are 8 million ounces just behind Russia in terms of gold production. Okay, so the third theme that we'll discuss with you that's interesting in Africa is the South African government bonds. And over the last 6 years, a lot of African countries have been issuing government debt in dollars. And these bonds are listed in Europe or in London and traded in Europe and pay interest in dollars, or some of them pay interest in euros. But the spreads on these bonds over treasuries are at their record highs. This is a chart from Standard Bank puts together. They have an index of South African government bond spreads, and they're at the highest ever at 10%. So if you look at slide 24, I think it's just interesting to compare what yields you can get across the world. And if you look at the US down at the left, 30-year bond at 1.3%. And then also when you look at some of these countries, the copper price has gone down, the oil price has gone down, but despite that, a Chilean 30-year is still 3.3%. A Russian bond is 3.7%, and even Saudi Arabia at 4%. I think you might have thought that those yields would be higher given what happened to the oil price, but they're still quite low. And then at the right, you see that a lot of African countries have, double-digit government bond yields. And as we've seen, some of these countries are getting quite good support from the IMF in these difficult times. So interesting that African government bonds trade with much higher yields than even US junk bonds. So just a second. I thought I'd finish up by just a couple words on the fund, and because I think it's a bit differentiated what we're doing. It's a multi-asset fund, so we're free to invest in both equities and fixed income, and we're quite active about the asset allocation between the different asset classes, and given the market conditions, we can vary from 60% long equities to actually net short, as we are currently about 7% net short right now. And we can also move around that fixed income allocation. Last year, we had about 80% of the fund in fixed income, both local currency and US dollar bonds, and not much in equities. So, that can move around, and that's quite active. I think that's different than your typical African strategy or emerging market strategy, which is probably just long only and fully invested all the time. And maybe just a word on the current positioning, the net short positioning. I think we're of the view that some significant shocks have happened to the economy right now, and as I do the bottom-up work, I think that the likelihood is that these are going to take a little longer than I think. When I look at the consensus, I think people are this is going to take longer to play out than the market expects, and so I'm not sure this is all factored into some of these share prices. So we're being very cautiously positioned right now with a small net short position. But as Io said, the opportunity is definitely on the long side, and for the longer term, these African markets look, I think, are unique, which is why we're doing the call. And so just to finish up, on the team, I think we have one of the best African investment teams. There aren't many funds that focus on Africa. There aren't many. It's a small community. We all know each other, but I think we put together a great team with Io as our CIO. Joe Delvaux is an expert on African fixed income. He's not on the call, but he's part of our team. And I'm the PM on this fund. So we all work well together. And I think we put together a good team for the asset class. I think it's interesting that we're flexible between equities and fixed income. I think that's unique, and able to find the best ideas in Africa. And also, with those different asset classes, we can move around and pick whatever we think are the best ideas, whether they're equities, fixed income, whatever country. But also we have a strong risk management overlay that comes with Hedge Invest. We work with Hedge Invest. They look at the portfolio. They do, correlation analysis to make sure that the portfolio is diversified and with good risk-adjusted returns. I think it's great that the fund has a 5-year track record. So, we've been managing through a difficult market, And you can see how the fund is acted, in times of volatility. So you get to, who knows what the future is, but you can see it's not like we're starting brand new, and you have some track record to work with. It's a UCITS fund, so you get all those, strong investor protection rules that come with a UCITS fund in Europe. And, I think we have had good performance for the market. I'd say one of the better performances, maybe one of the top performing funds in Africa. And to say just maybe on the final comments, I think maybe we launched the fund 5 years ago, and in hindsight, maybe it was a bit of a top of the market. Africa's gone down about 25% since we started the fund, but yet our fund is up. We've been able to generate positive returns for investors despite being in a bear market, and that's been tough. But I think, as I was saying, the next 5 years are probably going to be a lot better, and I think we can start to enjoy the good times and make some significant returns. And so we protected investors on the downside, but I think we're going to I think it's time for some good upside. So with that, Laura, I think let's open it up for some questions.
Yes, exactly. So for question, please use the chat so that we can see your question. Okay. Yeah, the first question is, how do you manage the FX risk?
Eric, should I take that?
Yeah, sure.
Yeah. Okay. So I mean, we invested in local currency assets, and whereas our base currency is euros. So this, of course, opens us up to FX risk. Now, while the portfolio, by mandate, we can hedge some of the currencies. A lot of the currencies, it's either too expensive or too illiquid for you to hedge. But on the other, as part of our own core investment philosophy, we actually don't believe that there will be much value to be gained from hedging, and that by hedging these currencies, you are going to leave a lot of returns on the table. Now, to explain further what I mean by that, the long-term outlook for the African countries and risk assets in Africa is hinged around transformational change. What we're talking about here is that these are countries which are better managed than they were in the 1980s and 1990s. You have much more reasonable monetary policy environment. You have a much more lower inflation environment. You have an environment of stronger economic growth. And what we are buying and what we are investing in is that whole package.
Sorry, Ariel, sorry to interrupt you. Just please speak louder, because I've been told you are a little bit low in terms of volume.
Okay. Yeah. So what the FX is part of the source of the returns that we are going to get going forward. Today, the average depreciation of African currencies against the US dollar is only around about 2.5% a year. Whereas if you were to go back 15 years ago, the average depreciation was closer to 8.5% a year. So these currencies have become far more stable. They can get periods of exogenous shock when they gap down, but for long periods of time, they are actually very stable. And over the long term, the FX losses are more than outweighed by the expansion in earnings that you will get in local currency. So our expectation is that local currency earnings will grow around about 9% over the next 10 years. If we lose 2.5% due to the currency, we would probably only, you are still going to be net around 6.5% to 7% in dollars. The second point is there is something happening in global currencies, which I think we are all yet failing, we're not yet understanding, or we're not yet seeing being adequately priced. And that is this massive expansion of QE that you're seeing in Europe, you're seeing it in the US, you're seeing it in Japan, where central banks are basically printing money. And it is leading to a complete shift in the way people, in the relationship that people see between monetary policy and the broader economy. It's simply economics 101. If you print more dollars and your dollar economy does not actually grow that fast, and you don't print more naira, over a long period of time, the naira has to appreciate against the dollar. In the world that we see today, that doesn't look viable, or it doesn't appear viable, but that is because we are all, it's a flight to safety. It's a flight. People are buying safe havens, and the dollar is, to put it bluntly, it's the best house in a poor neighborhood. But at some point, the dollar, by all this QE, it is being systematically devalued. The euro is being systematically devalued by QE. And over a period of time, as we go forward for the next 10 years, currencies and governments which are not printing money today are going to outperform those currencies which are printing money today. We will not, it is not immediately obvious when you're in the middle of the storm, but there is a devaluation going on among the developed nations' currencies, which is not happening in African markets. So I would actually, if you hedge currency risk today, you are going to lose a big chunk of your outperformance. While we have African currencies have lost money against the dollar over the last 10 years, I think the prognosis with the way QE is essentially a systematic debasement of these currencies is going to mean that over the next 10 years, if you are looking for currencies that are going to appreciate, look for those countries which are not printing money today. And in that regard, I think not hedging is actually the better strategy to follow, because you are going to lose a significant amount of your source of alpha and the source of your outperformance.
And Ayo, just another point on this specific question on Nigeria, Naira. So if you have a view specifically on that.
Yes, I do. We do, and the Nigerian, as I explained at the beginning of the call, the primary impact that this COVID crisis is going to have on African economies is going to be via their currency. And we will expect that the worsening of the terms of trade will mean that the currencies will have to take a hit this year. The Nigerian Naira, the Nigerian Central Bank, and the government, they form, or they belong to that group, as Winston Churchill said of the Americans, you can rely on the Americans to do the right thing after they've tried every other alternative. And the Nigerian Central Bank works pretty much along those lines. There is a fascination with holding the currency and with having a high, because it's a high import economy. They have a fixation with the value of the Naira, and they don't allow, they make continuous attempts to try to control or to hold the value at unrealistic levels. The drop in the value in the price of oil will mean inevitably that the Naira has to move. There's been a small devaluation of about 7%, but our expectation is that there will have to be more. They will slow walk it. It might take up until the end of the year. But by the end of the year, we will be looking and expecting the Naira to trade roughly around about 425, somewhere around between 425 and 430 Naira to the dollar. If the central bank was much more proactive, they should just allow that hit to happen now and take it, and then we all move on. It's more likely that it will be a slow walk thing, and while they wait and hope that there might be a recovery, sufficient recovery in the oil price, that devaluation does not have to happen. But I think what it does the rest of this year, holding the Naira at an artificially high level will compress growth. But as soon as they start to see that slower growth number, GDP growth falling from 2.5% to maybe 1%, they will know what to do. So yes, is the Naira going to fall? Our base case is that it will. Its fair value should be somewhere between 425 and 430. Will the Nigerian Central Bank do it tomorrow? No. But by the end of the year, we think they will do something. They will have no choice but to move, but to allow the currency to move.
Thank you. Then we have a question for Eric. So the question is if you can cover on the top 10 position and if you can give a view on the mining sector.
The top 10 positions, some of the biggest positions are Naspers, the technology company, Safaricom, to Aspen Pharma, which is a pharmaceutical company, two mining companies, B2 Gold and Endeavor Mining. Helios Towers is a cell phone tower company, very stable. So you see, we're trying to a bit of tech, but also trying to be quite stable with some healthcare companies and also mobile phone tower companies, paid in dollars, very long-term contracts, very stable. And then the gold miners as well. And you said, Laura, the overall view on the mining. Yeah, I'm pretty negative on mining right now. I was thinking I was bullish last year, thinking that the capital discipline in the sector was going to be enough to create a bull market, but I think just the downturn we're seeing in demand is creating a lot of pressure on copper, thermal coal, energy prices. Iron ore has been kind of amazing this year, and it's held up, but that's kind of around some short-term supply disruptions in Brazil. Vale, biggest supplier of iron ore, maybe it's second biggest, had some problems supplying iron ore. But basically, we're negative. Outside of gold, we're negative. So we're long some gold miners and then short some diversified mining companies on the other side.
Eric, on this point, many times throughout the years, many of our clients or counterparty asked us why to have a long-short product rather than a long-only product. So probably now we have in front of us the reason why. So would you comment on that?
Thanks very much. Yeah, I've had so many had to defend this view many years, and I think this year, showing that we're up positive return when various African indices are down 18 to 25%, kind of proves the point. We think that there's a lot of diversity in the market between the different countries and the different industries. You can still pick winners and losers, and it is a good market for long short. And it's taking a while for us to prove this, but over the time we've been generating positive returns despite the overall market being down. So I think long short has worked, and we said look, Africa's going to go up, but it's not a straight line. It's going to have its ups and downs, and I think with a long short strategy, you're going to get the best, consistent returns as a final investor. So, as you see this year, we've been able to protect investors, protect the downside, and I think Africa is a good market for long short.
I think we are done with questions, and we nearly take 1 hour of your time. So thank you very much for taking to be here with us, and we hope it was useful. And of course, let us know if you want to follow up. Many thanks to Ayo and to Eric for explaining us the Africa opportunities today.
Thanks very much, Laura. Thanks, Al.
Thanks, Laura.
Thank you. Thank you. Goodbye. Thanks.